Hey everyone, good morning. How's it going? I hope you all had a great weekend. Obviously, I'm not Roger. I'm taking over for him for this week, and I think we'll have a really good time together. If you have anything that you guys want me to cover over this week, please send them over to keen@investpub.com and I'll be sure to cover it. So today I've got some great stuff planned for you guys, but let's just wait for people to get into the room. Um, Let's see. Omar, hey Omar, Robert, Kevin, good morning. Jill, 407-496-4077. Good morning to you. David, Bill, Zoom user, Donna. Hi Donna. Christopher, Doug, Omar. There's a lot of people. Hey Murray. Who is the feature trader of the week? Blaze. Yes, Blaze can be the feature trader of the week. Yes. Good morning, Chad, Ivan, Cyrus, Hopium, Leslie, Scampy. Roger gets a lot of people in this room. That's awesome. Okay, so is this income daily? No, this is Roger's VIP room. Hi, John. Good afternoon, Carrie, Daniel, iPhone, Carlos. All right, back in Kauai. All right, are you from Kauai? Is that where you're usually? That's a pretty good place to be from. Except I guess you have to get up super early if you want to trade, huh? All right, Jimmy and John, Joe. All right, let's take a look at what's going on in these markets on vacation. Okay, great. So so today I'm going to talk about volatility. Some of you may have heard me talk about volatility before, so I'm not going to go over exactly what I've gone over in the past, although if you can find it, I was on, I think it was a panel, or it might have been an opening playbook a couple of times talking about volatility, and people learned a lot about that. I'm going to go into more depth about volatility, exactly what it is, how do we measure it, how do we trade it, when there are certain conditions for certain types of trades for different type of volatility environments, and then we'll go over whatever you guys want to go over. Maybe we'll look at some stocks, we'll look at what's going on in the markets, and John Arnulfo. There's a lot of people. If I missed you, I apologize. There's just so many people here. Hey, Ken. Okay, so let me start sharing my screen. And if you want to be part of my Telegram, I'm not nearly as active as Roger is, but I do generally send stuff out at least, well, once per day, once every couple of days, looking at the market, giving gamma levels, things like that. So if you want to join tradingpub.com/Kane. And also next week, starting next week after market hours, I'm going to be doing similar to this, similar to live VIP, Roger's live VIP room. I'm going to be doing a live market analysis after market hours because no one's doing that right now. So I'm going to fill up that time slot. So if you're interested, I'll have details for that over the next couple of days. But my YouTube channel is youtube.com/@gammapockets. So like that. I don't know if you can see that. So I'll send it to everyone. There you go. And if you, it's been a couple months since I've been active on that, but I'm going to start being active on it again next week. I'm doing VIP, Rogers VIP this week, and then I'll continue next week in my own room. So let's take a quick look at what's going on in the markets, huh? SPY moving up. So we had an all-time high on Friday, another all-time high today, but basically we opened pretty much right at the all-time high. We opened at 617.38. We had the high is 617.49, so we didn't go that much higher, and then we've traded down. We haven't really traded all that much. It's been fairly quiet. If it's this quiet on Monday, it's just going to get more and more quiet as we get to 4th of July weekend. So we're not really going to expect a lot of movement, a lot of action this week. But also, though, we have to take that with a grain of salt because if there's less participation, there's less volume, then prices could move a little bit more volatilely, which is why we're talking about volatility today. So there's a big gap in SPY. Well, we got a kind of a gap today, a little bit of a gap. We've had a few gaps, and that's pretty unusual. And we are starting to move up a little too quickly. This is a little bit more than linear. If I were to draw a curve, I don't know if I can, let me see if I can draw on the screen. Probably be easier than trying to draw on the trading view chart. And let's, okay, so if I were to, is this mapped correctly? No? Draw pad? No? My draw pad isn't working. Okay, so it's kind of like that, right? It's the slope is getting higher and higher. So this is starting to move parabolically, and we don't see a lot of parabolic movement in the S&P 500. It's pretty hard on a major index to get parabolic type of movement, because if we think about what would be required in order for that to happen, either a whole bunch of mega cap stocks have to start moving parabolically, or a whole bunch of, like, a few hundred stocks in the S&P 500 would all have to start moving parabolically. So it's pretty hard to get that type of coordination inside the S&P 500. And if we look right now, it's most likely driven by mega caps. We'll take a look at that a little bit more carefully very soon. But I just want to point that out. This is starting to get far. This is also a little far away from that EMA 8 or EMA 20, whatever you'd like to look at. And when we get those big deviations, then generally, especially on the SPY, then that mean reversion really starts to kick in. So we want to be careful of that. We don't want to go super long right now. We don't want to be short either, because that's counter trend. So unless you're a counter trend trader and you know how to trade that, you're looking for really short-term moves, maybe day trade moves, in order to capture that. We'll talk about that a little bit more when we talk about volatility as well. So one way you can check that is if you have, I asked Ippolito some serious questions. Okay, I don't know about that, Ivan, but Lance will be here later in this room a little bit later. So just hang on, maybe he'll answer your questions in roughly half an hour to 40 minutes. Okay, so just hang tight. I'm sure Lance will take care of you. Okay. This is not Lance's, well, I mean, Lance is going to be here in about 40 minutes. So, so just hang tight. If you're here for Lance's presentation, we'll talk about what he wants to talk about soon. Hi, Vladimir. So one way to look at this is deviations from the whatever moving average you're looking at. Right? And one volatility measure that is a favorite amongst, actually one of my favorites and amongst professionals, is ATR, average true range. So what's an indicator that shows you average true range or numbers of average true ranges away from a moving average? So that is to the Keltner channel, right? Keltner channel. Have you guys heard of the Keltner channel? Okay. So let's see. Okay, so Keltner channel is just in the middle. It's a moving average, generally EMA, and then the upper or lower channels are a certain number of ATRs away from that moving average. So if I go over here and I do a Keltner channel, I can then change my length. So it generally defaults to 20, but if we're checking from the EMA 8, because we're looking at a shorter term move, and then we can say oops, that's not what I want, 1 ATR away from that. So if I go 1 ATR away from that, then I'll get these bands. Let me get rid of these other moving averages. Okay, so we start to see how often does the S&P move 1 ATR away from its EMA 8. Okay, so on the way up, it might stay at 1 ATR, then it deviates away from it, and then it reverts back to the EMA 8, or even to 1 ATR down. Okay, then we do it again. Once it pops out, then we pull back. Once it pops out here, it's following it exactly 1 ATR, can follow it for a few days, then it pops out, maybe for a couple of days, and then it pulls back. So we see this repeatedly. Gapped up above, stayed above it for a few days, pulled all the way back down to -1 ATR. Okay, we followed it up, pulled back to the EMA, and then eventually down a little bit beyond the 1 ATR. And this is a break of trend, right? So that now it went sideways. So now we're going down. So we're staying at 1 ATR below, come back to the EMA 8, then positive, then we come back down, okay? So whether we're going down or going up, we're seeing the same pattern. We hit that EMA 8 right here, pull back to the, the +1 ATR, back to the EMA. Up here, a little bit above the EMA 8, it can continue for a few days, then it pulls back all the way to the -1 ATR. So what we're seeing here is not necessarily just a pull back to the EMA, pull back to the EMA. Well, so if you're following a system like Roger's A-line, your expectation is that it'll bounce off of the EMA. And what we're seeing here is on the SPY, actually, once we go a certain distance beyond the EMA, then the pullback has a tendency to go all the way past the EMA and to the opposite direction, ATR. So that's where we are right now. We've gapped up to the 1+1 ATR. We're following up. The last 3 days we're above it. So how much longer can we go before we pull back to the EMA or -1 ATR level? This one was 1, 2, 3, 4, 5, 6, so about 1 week. And that's generally within 1 week. What we've seen in all of these patterns is that we have that pullback. So we're pretty far into it, right? We're 1, 2, 3, 4, 5. So we're basically at 1 week. So another 1 or 2 days, or by the end of this week, we can positively expect that based on S&P's behavior, that we're probably going to pull back at the very least to the EMA 8, if not all the way to that -1 ATR. So that might happen to coincide with a EMA 15 or EMA 20. I don't know. We can look. Okay, so I've got that blue is that, well, I guess it doesn't help that everything's blue. Let's change this to hot pink. Okay, you can see that EMA 20 is not too far from that -1 ATR. And if we look at if I do 15, I think Roger sometimes likes to look at 15. Okay, then 15 is a little too close. That -1 ATR, we might blow through that 15, EMA 15 a little bit, okay? All right, let's see what you guys are saying. Sort of like Bollinger Bands, that's correct. Yeah. Okay. All right. Can I turn up my mic? Yeah, let me see if my mic got turned down. Yeah. Okay, is that better? Better volume? We have been trading it so much. Yes, especially we have been trading so much. What have you been trading? I'm sorry, I lost context, so I'm not sure what that was in regards to. Okay. So this is volatility. If you have a question, just type it. You don't need to raise your hand. Okay. So that's where we are in the S&P 500. We're just going to expect that we're probably going to have a mean reversion, baby pullback soon to the EMA 8 or perhaps -1 ATR beyond the EMA 8. So what that means realistically, though, is we're expecting a 2 ATR movement, right? So 1 ATR, or actually a little bit greater than 1 ATR, to get back to the EMA, and then another ATR to get back to the bottom. But remember, everything's still sloping up. So two ATR is a good estimate. It's not going to, like linearly from today, it would be more than two ATRs. But since everything's moving up, then, and if we drop at the same time, then it's going to be more like two ATR movement. So you have to ask yourself, in this type of environment, do I want to take on new longs? And the answer is probably not. If you're going to expect this to come back, isn't it a much better entry if I just wait to the EMA8 or that -1 ATR? And most stocks have at least a 70% correlation with the S&P. So if we're going to expect a pullback on the S&P, then we should expect a pullback on most stocks. The exceptions would be the ones that have extremely high relative strength to the S&P 500. That's why relative strength forms the basis of all of Roger's stuff. And it is a really great place to start. All of my stuff starts with the market maker, but relative strength, what I'll look at next is relative strength. So relative strength is super, super important in the markets. Then you go, well, what if I find some relatively weak stocks and go short because my expectation is the S&P will revert at the very least to EMA, maybe -1 ATR, actually pretty good chance to the -1 ATR. You see it +1 ATR, eventually we pull back to the -1 ATR. +1 ATR, eventually we pull back and touch that -1 ATR. That's a normal pattern during an uptrend. So can I do a short-term short? And the answer is, again, if you're going to go counter trend, then we want to make absolutely certain that the stock is extremely weak to the market. So again, relative strength comes into play here. So we want to be able to focus in on the ones that are really strong and the ones that are really weak. One way to do that is to look at 52-week highs, 1-year highs, or whatever time period you like. So some people like 52, some people like 26, so half a year, or 90-day high, so roughly a quarter. So whichever one you want to pick. Of course, the longer term it is, then the stronger relative strength. But I wouldn't go lower than a 90-day. So Roger has these scans. He has these stock fetcher scans. I don't know if mine are exact same as his, but they should be pretty close. So if you look at 90-day highs, this is why he's looking at the number of 90-day highs versus 90-day lows. There's a lot of 90-day highs right now, 328. So that is indicating, so the S&P making a new all-time high, it shouldn't be surprising that there is a lot of 90-day highs. What I want to know is the S&P is making an all-time high. So for sure it's making a 52-week high as well. How many 52-week highs are there? Because if there's not a lot, then that tells me that mags are driving it, or large caps, super mega caps are driving it. So it's not too surprising that there's a bunch of 90-day highs. That doesn't give me too much information at the moment. And if I go 52-week highs, oh, actually, is this for just S&P 500? I need to make sure. No, these are across all stocks. So market is SP 500. Okay, only 19. So there's only 19 out of 500 stocks in the S&P 500 that are making 52-week highs. So that doesn't inspire a lot of confidence in me that this is a really strong upward move. So I would definitely now lean towards a pullback very soon, because we're only being driven. Which stocks are driving them? Let's see. Bunch of finance and banks. Then we've got aerospace, defense, and then we've got some media, some communication stuff, some internet stuff, communication stuff. Okay, so it's actually finance looks like the strongest right here, and then tech and communications. So QQQ, right? QQQ type stocks. And yeah, QQQ is deviating also. It's getting way up there. Okay. All right, let's see what you guys are saying. I don't know how Roger sees his chat at the same time. We got to figure out if he's splitting his screen or what. Oh, you guys have been trading SPY a lot? Okay, great. The indicator I'm using, this is the Keltner channel. It is the Keltner channel, and what we're looking at right now is set to the length is set to 8, so the middle will be the EMA 8, and then the multiplier is 1 ATR. So when we set it this short, it's pretty rare that we'll actually hit 2 ATRs above, and so it's not too useful of a measure. You can see sometimes we do, but you can throw multiples up here. So I just, if you do another Keltner channel, okay, so that one's the 20, and then I'll set, or what I like to do actually is, I messed that up. If I do 8 and then a multiplier of 2, then I can throw on another Keltner channel. And this one I'll put it at, what the heck? I used the wrong, must be Keltner. So we'll put on 8 and a multiplier of 1 in a different color. I don't need that basis because they're all going to have the EMA 8 as the same middle line. Okay, so now I can see. Okay, we gapped up here to the +1 ATR and traded all along it until Friday. We started to get above. We got almost to a 2 ATR, and today we're sitting in middle of these two, so probably like a 1.5 ATR. So if I move this to, or I could put a third one on, but generally 1.5 isn't super. Yeah, it's perfectly 1.5 right now. But generally I'll look at 1 and 2, and sometimes maybe 3. Although on an EMA 8, to hit 3 is really, really unusual. Okay? You might hit 3 on an EMA 20, but not necessarily on an EMA 8. Okay, so that gives you a little measure of just how overextended we might be. Remember what average true range is, right? So true range is today's close minus yesterday's high, today's close minus yesterday's low, and then today's high minus today's low. The average of those three, I'm sorry, the maximum of those three, and then averaged over the number of days that you're looking at the ATR. So basically what it's measuring is including the gaps, including the opening, close, and gap, how much does this stock move on average over the past X number of days? So if we're going higher and higher, then there's 2 possibilities. So remember, if I have 5, if I'm doing ATR 5, because I don't want to sit here and draw 10 of them, every day I lose this one and I gain one more. And I lose this one. Oh gosh, my mouse is not, okay. And then I gain another one. So what has to happen in order for an ATR to increase is that this new one has to be bigger than whatever this was. Okay, so that's the easy way that most people might understand intuitively why an ATR might increase. I lose this one and I get an even bigger one over here. But what could be a little deceptive is if I had a huge one like this, and then I have, these are actually increasing like that, then even if I get an increasing one right here, even it's not as big as this one. So if I get rid of this one and I get this one, then my ATR actually goes down. Even though actually over across these days, my ATR went up. So an ATR is not too useful if you go way too far out. So if you say, hey, what's the ATR over the last 90 days? I'd be like, I don't really care. You're going to get a lot of noise in there. But if you shorten your ATR, then it becomes a pretty good measure, because the likelihood of you getting this giant movement on a single day, and then having it affect your overall ATR is low, the smaller that number is. And I believe, I've never talked to Roger about this, but I know Roger likes to use a 10-day ATR versus a 14. I like the 10-day also. And this is one of the reasons why, is because so you're less affected by this. So for example, this was a big, huge move. And if I try to say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, if I get this bar, right, this change right here, so the high minus low is definitely the biggest right there, versus this change right here, then my ATR is going to suddenly move lower. And that's not a true reflection of what was happening in the ATR. Right? So if we shorten it to 10, then we get this right here. And then it'll affect it for sure. But the effect here will last for 14 days, and the effect here only lasts for 10 days. Okay. So we're going a lot slower than I anticipated. I'm giving you guys less content than I thought I would. All right, so let's see what you guys are asking. This doesn't look like what you've used for Keltner channels before. Is this Bollinger Bands around EMA8? No, this is Keltner channel. Keltner channel is the EMA8 plus one, or a multiplier of ATR above and below the moving average. A Bollinger Band is very similar, except it uses standard deviations above and below the moving average, not ATR above and below the moving average. Okay, so they're very similar concepts, but since you're using standard deviations, you get even bigger. So if I look at Bollinger Bands, so if you look at this, these are pretty much linearly wrapped around the moving average. Okay, so let me get rid of one of these. Let me get rid of this one. Okay, so they're pretty much linear. And so you do get some expansion because ATR increases, okay? But they're kind of pretty much linear across that moving average. If I throw a Bollinger Band on here, what you'll see is that you'll get, like over here, you see a little bit of a bulge right here because the ATR shot up because of this huge candle right here. You'll get way more of that on a Bollinger Band. You'll get these giant bulges because the standard deviation calculation, how it differs from the ATR calculation. So if I throw on Bollinger Band around the 8, okay, and do 2 standard deviations. Okay, you see how it gets super bulby like that? Gets these right here. And if I throw the Keltner channel on top of that, I don't know if that's going to be too cluttered, but okay. So that blue, see how that red bulged out of that blue and the green bulged out of the blue on the bottom? And then over here, it's much tighter, whereas the ATR channels stayed pretty much a fixed width above. Okay, so you get that bulging and compressing effect a lot more in the Bollinger Band because of the way that standard deviation is calculated. Let's see, what else? How I use stock fetcher versus Roger. Yeah, it's similar. I don't know how differently he uses it, but yeah. I learned to use stock fetcher. I learned about stock fetcher from Roger, actually. Is there a good this is good for seeing a pullback to the EMA, yeah, and actually potentially beyond a pullback beyond the EMA 8, right? So if you're setting stop losses based on ATR, so have you guys taken Roger's bootcamp? If you take Roger's bootcamp, he goes over something that I think originally the first person to publish it was, I believe, was Van Eck. And he goes over risk units, one risk unit above or below. So if I, for example, if I wanted to enter QQQ here, which is not a good idea based on everything we've talked about so far, is that if I'm right here, then even if I have an edge, I can only positively expect that I might make the next trade, I still only have a 50-50 shot. Okay, so if I have a coin flip and I flip the coin, I flip the coin, I flip the coin, then the coin flip is, it's 50% every time. But if I say, okay, we've got 100 in a row on heads, what are the chances that we get heads again the next one? Well, if I'm only evaluating the one, then the answer is 50-50. And then if I accept that the coin is actually a 50-50 coin, it's not weighted in some sort of weird way, then yes, the next flip is just 50-50. But based on the sequence of statistics and knowing that you've flipped it so many times and you've gotten heads every single time for whatever reason, then if I flip another 100 times, then I should get a unusual amount of heads or tails. I don't remember what I said. The other one than what I said. And if I flip it another 1,000 times, then I should get more of the other one of whatever I said versus the one that I said in order for those statistics to play out and get back to 50-50. Okay. So realistically, we would never see 100 in a row, because if we have a true 50-50, there's only so much deviation that we can get on a small, even on a small sample size. So basically, if I said, let's flip a coin 100 times in a row, the chances of us getting 100 heads, while technically is not zero, for practical purposes, it is zero, right? No one's going to sit here and bet me that we're going to get 100 heads in a row or 100 tails in a row. No one would take that bet. So the same is true for 99, 98, 97, 96, and then the odds increase as we get closer to 50. So what we're seeing here is now that we've gotten to this deviation, then statistically, based on behavioral systems, there's only a certain amount that we can expect that it could continue to go up without pulling back. And if this is my entry, then, but if I'm looking at a single trade, I have to treat everything as 50-50. Otherwise, my risk management goes way off. So if I treat every trade as 50-50, even though I might have a system that like makes me 96% wins, it doesn't matter. I still treat every one as 50-50. I think you may have heard Roger say something like, I treat every trade as if it's going to be a loser the next time, right? Even if I have a 99% win rate, I treat it as if it's going to be a loser next time. And that it's the same idea, except a little bit more extreme. I think of every trade 50-50. I only have 50-50 shot. It's either going to go up or go down. It might go sideways, but eventually it's going to go up or go down. So you set one risk unit down, and if you want a positive expectation, you've got to have at least one risk unit up. I'm sorry, more than one risk unit up. If you just have a 1-to-1, then all you can expect is break even. And so Van Eck, I believe, was the first guy who said, okay, well, every single trade, then you should have a target that is more than one risk unit. So if this is one risk unit, then this should be 1.5 or 2 risk units away. And that way, if I have a 50-50 shot, then I make more than when I lose. Of course, that's not perfect because I don't have a 50-50% chance of going down one risk unit and going up 2 risk units, right? So that should not be 50-50 because I'm traveling two different distances. And that's the idea behind implied volatility. When market makers are introducing implied volatility, and you can create a range of this is where the market maker expects plus or minus, this is where it's going to go. It's always the same number, same price above and same price below. So if I go over here and I look at we're talking about QQQ here, so I might as well. Okay, so I look at this market maker move, or if I looked at this implied move right here, it's always plus or minus the exact same dollar amount. The exact same. Plus, it's not +3 -1, right? It's never that. It's always the exact same number, because that is what gives you the equal probability above and below. So this isn't perfect, because if I say I'm only going to give this one risk unit down and two risk units up, then it's no longer 50-50. But that's why you still need an edge when you trade like this. So if we do this, how do you define your risk unit? Well, one idea is that if I'm wrong, I don't want to be wrong because of randomness. I want to be wrong because I was wrong. So if you go and you say, hey, I'm going to go to a job interview tomorrow, and there are 10 candidates, or just say there's only 2 candidates, and you both interview, you're both sitting there, and the interviewer goes, oh, okay, hey guys, I'm not going to ask you any questions. All I'm going to do is stick my hand in a hat and draw a person's name out. And you lose and you don't get the job. And you go, what the hell was that? Why did I lost the job completely due to randomness? Not because the guy was a better candidate than me, better fit, better experience, or not on any sort of merit. I lost the job simply because of randomness. That's not a good feeling, and that's not a reason why you want to be on the losing end of something. If someone said, I went to an interview and I saw the other guy and it's like, wow, this guy has way better education than me, way more years of experience. I've traded $200 billion a day. He's traded $500 billion a day. He's worked at 3 different multi-trillion-dollar funds. I've only worked at one $1.7 trillion fund. Wow, this guy is better candidate. He's a better candidate. I don't mind losing to that, right? I'll find another job somewhere else where I'm better fit. So the same thing is on your trade. You don't want to lose a trade because of randomness, because one of the worst feelings for traders is, oh my God, I got that, is you want to define what is a random amount of movement. And if we know that this stock normally moves this amount, which we call an ATR, then you want this risk unit to be at least 1 ATR. Okay. The shorter time frame that you're talking about, the smaller ATR you want it to be. So if I'm doing a one multi-year trade, I'm probably not setting it at 1 ATR. I'm probably setting it at 5, 10 ATR, and I'm looking for 20 ATR return. If I'm doing a super short term, well, I definitely don't want it less than 1 ATR because it's too easy to take me out due to randomness. So on a short-term swing trade, I would define it at the very least at 1 ATR, and then my target should be more than that, 1.25, 1.5, 2 ATR, some people 3 ATR, but 3 ATR is really tough. That's going to put you into a longer trade, and you're going to see that pull back against you several times before you get there. But we define it in terms of ATRs away. Now, why did I say this is not a good entry? Even if you have this great management or risk defining system, why is this a bad entry? Because we want to put things in our favor, right? So let me get rid of this. Let's just put in our normal EMAs. Okay. If I manage to enter right here, oops, let me erase all this. If I enter right here, right off that bounce of the EMA 20, then what I'm saying is I'm giving myself one ATR movement downwards, but I have a technical support. So now I have a double reason for us not to hit a random stop out. If it breaks and it breaks my one ATR level, then it might keep on going down. It also does something interesting, which I started to talk to you guys about earlier, was that prices don't always just bounce off of EMA. When we looked at this Keltner channel on the EMA 8, what we saw is that oftentimes it reverts to the -1 ATR. So if I put my, I should have done it on an EMA 8, not an EMA 20, I'm sorry. But if I put my entry right there on a bounce on the EMA 20, and I put a 20 Keltner channel right there, okay, then what happens is on my day of entry, I gave myself one ATR. So I gave myself a support, and I gave myself another support one ATR away in order for me to not get stepped out, because a lot of times we bounce off that -1 ATR and go higher. So I won't stop myself out because I know that there's a decent likelihood that it could go down to the -1 ATR and it might bounce from there. And so you, okay, well, why don't I just put it at the bounce off of the -1 ATR? That's great. You can do that. And it would be excellent. You'll just get less trading opportunities. So sometimes higher probability also means less trading opportunities. It doesn't mean maximum profit, right? Higher probability generally is not maximum profit. So this is what professional like Wall Street does. We care about how much money we make at the end of the year, not how many times we were right. If you are right 90% of the time and can make $1 million being right 90% of the time, but if you allow yourself to go down to being right 65% of the time, but you can make $5 million, which one would you rather have? Well, it sort of depends on where you are in your trading journey. You might need that 90% in order to be confident and to be able to keep on taking trades. And maybe if you only won 65% of the time, you would lose faith in the system and then you just quit. So then you don't make that 5 million, you won't even make the 1 million. You might even end up quitting when you're a loser, and you actually make negative money. So everyone has to find their own place on what they're comfortable with and where they are in their trading journey. So in our advertising when we're trading systems, we like to give you guys the win rate, and a lot of you guys find comfort in the high win rates. But just to understand that that's not the maximum profit. we're designing, a lot of these programs are designed for comfort, to help people get confident. As you get to be a more experienced trader and you're winning 90+% of the time or 80+% of the time, consider evaluating your system and saying, hey, if I took a different entry, so hey, if the -1 ATR is the highest probability entry, okay, but I only get to trade it 10 times a year. The EMA is still a high probability entry, but I get to trade it 50 times a year. I get to trade it 5 times as often. And so, yeah, even though this one is more profitable on each trade, over the life of the year, I'll make more money off of bouncing off the EMA and accepting that I lose a certain percent of time more often than if I went that -1 ATR. Okay, so we're seeking that balance. Usually, Wall Street will focus on what makes you the most money, but as a retail trader, you have to find it for yourself. Am I more comfortable winning more often at this stage of my journey, or am I looking to start maximizing my profit at this stage of my journey? All right, I keep losing my chat. I never, let's see. Standard deviation overemphasizes values far from center. Yeah. Okay. I always have an expectation of 50-50 as well. Good. Try to plan trades of at least 2-to-1. You love 3-to-1. 3-to-1 are hard to come by. You're going to, it's very unlikely to be like a linear move upwards. It's going to be up, then down, then up, then down. So from here to here, actually, let me see. From ATR right here is about 6.5. So if I go from here, from 507 to 520, or sorry, 527, that is, where's my horizontal line? 527-ish from 507, right there. Okay, so in order to get the 3 ATR, you got to go up, then come all the way back down, and then go up, not quite get there, come down, and then come up. Okay, if I accepted, say, 2 ATR, then a 2 ATR could have been, what is that? About 13, so about 520. Okay, I could have made my money. I could have entered a second time. Okay, and then like 1.5 times. So basically, I could have made 3 ATR right here, or I could have made 2 ATR twice. And I would have made more money, right, if I did that. So that's sort of the similar point to what I was making of. Sometimes you go for the high win rate, depending on certain reasons, or are you trying to maximize the amount of money that you're making? So we might think that, hey, 3 ATR move, I'm maximizing the amount of money I'm making. You are on a per trade basis, but you may not be on a time basis, on time value of money. Okay, so 2 trades in the same time period as the 1 3 ATR trade, I can make 2 ATR trades and make more money. Okay, what is advantage of trading E-M? I'm not sure what E-M stands for, Catherine. Okay. What about use of Darvos box in trading? I'm not familiar with the Darvos box. I've actually never heard of that. I'll have to look up what a Darvos box is. Maybe I'll look it up right now. Darvos box. Trading strategy that involves buying stocks that are hitting new highs and selling when they fall from these peaks. How does that, I don't know how that makes it. You buy when it hits a new high and you sell when it falls from a peak. I wish they had a chart, because that doesn't, are you saying that, hey, we hit an all-time high, let's buy it, and then we'll sell it when it drops from that all-time high? Or are you buying at an all-time high, expecting it to go even higher, and then when it pulls back, then you sell it? I guess would make more sense. But basically what you're doing then is you're buying a breakout of a high, breakout of all-time high, or a breakout of a 90-day high or 52-week high or whatever. That is a lower probability setup, but it can make more money. So this is exactly the trade-off I was talking about. Are you going for high probability or maximal profit? And so we would have to do studies on which one would actually end up. So sometimes higher probability is higher profit, because what you make versus what you lose when you go for the lower probability event doesn't make up for the inefficiency in profit making from the higher probability event. So you would have to run that study. I don't know. ATR based stops and targets are absolutely the best way to enter and exit your strategy. ATR's average true range, and I gave a brief definition of it earlier. And then, so maybe if I have time, I'll go over it again. Seems that things would be in your favor. You're planning a downside trade. In context to what, Doug? It works the exact same. risk units up versus risk units down, exact same, works the exact same way, whether you're bullish or bearish on the particular stock. But you want to stack things in your favor, right? So if you want to stack things in your favor, then you trade with the trend. Then you put your entry mark near an area of support. You allow your stop loss to be outside an area of likely movement from your entry. And then you put risk units more at least as much as whatever your risk unit to downside was. And then you add relative strength on top of that. Okay, cool. E-mini. EM. What is the advantage of trading E-mini? I guess was the question. It just depends if you want to be a futures trader or a stock and options trader. Futures is leveraged, so it can be a double-edged sword. I'd be very careful with that. So basically, you would want to very carefully evaluate if you want to be in E-mini. E-mini also trades 24 hours or close to 24 hours, so there are certain advantages and disadvantages. Okay. All right, looks like we got Lance here. How's it going, Lance?
Very good. How are you, Kane?
I'm doing great. I'm doing great. We were just talking a little bit about volatility and entries and risk reward. I started a little tiny bit to allude towards like a market maker move or implied move, but we didn't quite get there. So that's what we've been talking about.
Yeah, I heard a little bit about the E-minis compared to other uh, the advantages of it and stuff like that. So I thought that was cool. It's what I used to trade mostly back in the day.
Uh,
Uh, and yeah, volatility up again today. It's kind of odd. The past couple days, we've had VIX up, SPOOs up. SPOOs is
yep.
S&P minis. Um, and with that, the implied move is actually stayed pretty high because obviously the VIX and the VIX is a measurement of SPX options or S&P options. But I think it's because, and Kane, let me know if you agree. I think it's because the trade deadline deal uh,
Yeah.
that's
Yeah.
approaching. So they're going to keep the VIX kind of elevated till that becomes known, so to speak, I think.
Yeah, I think that's exactly right. Plus, if you look at, anytime the market goes up and the VIX goes up, that is a sign to me that we might have a pullback or reversal pretty soon. It's sort of like the analogy for me would be a bubble. Like you have a
Yeah.
bubble and the hysteria is building, and so that's ripe for a pop. So be careful of a pullback pretty soon here.
Yeah, I think we had that huge swing Friday. I mean, it was great for us because I sold, during the 4 p.m. payout plan, the trade worked out perfectly. But I mean, if you really think about it, we had about a 50-point swing in what, 2 hours? And then we had
Yeah,
a 40-point swing in an hour. And that was just Friday. So when you're having, literally double to triple the market maker's expected move, they're gonna keep option prices elevated. So
yeah,
if you're trading, you're like, hey, I bought calls and the stock's up 1 or 2%. Why aren't my calls moving? It's because, pretty much the vol is priced in everything. And also too, if you're looking at put options for, a hedge or a pullback, with the rise in VIX, you can puts are going to be also and insurance is going to be a little bit more expensive, but what you could do is do something like a bull call spread in the VIX. But I have noticed if I'm looking at my junkie stocks, I don't know if I could grab the screen real quick,
yeah. I'll stop sharing.
but if I look at my junkie stocks, and I gave this away, and I know a lot of y'all have it. So I can pull it up here. It is, yeah, let me share a portion of it. And I have a lot of these stocks, so obviously I like, days like today, but it's also a little bubbly, it would be a good word. But if you look at like the number one or the top stocks that are moving, you know, in the chat, what do all these stocks have in common? Big Bear AI. Remember that one from $3 to $10? Now it's starting to run again. Here, I actually pull it up on a chart too. So just so y'all can see kind of, you can, whatever your opinion is, market bubble, market non-bubble, whatever it may be, but to show y'all how little stretched we are. And usually when you have moves into really high risk stuff, it's because the market's not moving. So
Mm.
the S&P is not moving. So you have to chase return somehow. So what do? You make a market. So like Big Bear AI, the stock has almost doubled in a couple weeks. Newsmax, recent IPO stocks, right, having a big move past couple days, up about 12% today. Hood, you know, flirting with 100. I did call spreads in that one, sold them at 50% today. Bull, this was another name in the option pit we did. It's Webull, up 9%. But you have quantum computing stocks, crazy stocks, your Joby, right? Your aviation stocks. So all these stocks have one thing in common, and they're all stocks with high short interest, right? Supermicro at a 50 print. So these stocks are heavily shorted. So what you can see, it's kind of like, remember when GameStop $200-300 and it was kind of
Yep.
a bubble? Since the indexes are not moving, like if you pull up, let's say the QQQ, and I mean, yeah, it's moved, like to be fair, but today it's up 0.5%, and that was in the overnight session, right? Not the U.S. equity hour, the NYSE session. You're having people go into these stocks that are, you know, usually real bad companies where there's a lot of high short interest, like First Solar, like basically anything with a bad chart is going up. And your good companies, right? Maybe not good's the good word, but kind of your safe companies where people will be like, oh, I think Occidental Petroleum has good fundamentals. Well, no one cares. Or stocks that pay a good dividend, like a healthcare company. You look at, let's say, XLV, nobody cares. All these kind of solid balance sheet, good stocks and good uh, sectors, or like an Amazon. Oh yeah, Amazon's great. Well, it hasn't really moved at all compared to those highly shorted stocks where you're literally seeing all the moves. So it's fun if you're like me, kind of a dice roller, who likes to buy short dated options in stocks. But it's almost like being drunk at a party. Eventually, you're gonna have one too many drinks, and the hangover is gonna come, and you're gonna feel it. It's just, when is that gonna come?
Yeah.
The music's still playing, and people are still drinking the Kool-Aid, put it that way. Um,
Yeah.
and if you look at the option flow too, I mean, that's exactly what you're seeing. I mean, again, kind of Big Bear, some quantum computing stocks, Snapchat, your Maros, your cryptos. If you look at Big Boy Scanner, you got Kava, recent IPO, Lyft, super high shorted company, NU, I think that's a Brazil fintechs. You're having like Etsy, Coinbase. You're not having, your Microsofts, your Intels, your uh, Nvidias even. It's we call it, I call them junkie stocks moving, and
Yeah.
it's fun, but it's not something you want to go all in on. Put it that way.
Yeah, it's like the shorter term you go and the more capital that you have to deploy, the more volatility you need, right? So if you're a high frequency trader, if you're one of those quant desks that just depends on volume, then they can't get it in the large cap stocks, then they'll go to riskier and riskier stocks in order to get it.
Exactly, and I mean, what we're seeing is the complete high risk of the high risk. So all I'm doing, Kane, is I'm keeping it very basic. And when I mean basic, I mean simple. And like, here's a chart of the S&P. Let me turn off my alerts. Intraday. And I mean, the market maker move is only 13 points
Mm,
between now and 4 p.m. And why is it only 13 points? Well, here's the open, and look where we are. We
yeah.
are about 1 point off the open, and we're trading for what are we 3-4 hours into the trading day, and we have not. I mean, look at this range, how tight it's. So all I'm doing is like today, yeah, I'm gonna pull up my one with my indicator on it. So I just sold the bear call spread. As long as we stay above or stay below 60, what did I do? 6, 2, 10. So I got 20-point cushion. I make full return, max profit. And, I got literally 20 points. We could go all the way up here. And that's it. I mean,
Yep.
very, very basic. And the trade expires at 4 p.m. Like,
Nice. Yeah.
simple. Not trying to get too here. We gotta go all the way up here to, see a loss. Actually,
Yeah.
60, or pardon me, 6, 2, 10. Sorry about that.
Yeah.
Sold those calls.
And what's cool is, you're only putting on that bear side. So if it does absolutely nothing like it's so far today, you're good. If it goes way down, you're good. And look how far of a cushion you had for it to go against you, and you're still good. So that's awesome.
Yeah, I like the big cushions. I mean, as long as the market doesn't rally 20 points. Oh, no, I can't write there. As long as the market doesn't rally 20 more points today, and it's not expected, it's only about 14 points,
Yep.
13, 14 points. The market could crash. That's fine. Market go up,